Hello everyone, this is Ted Bauman here, editor of Bauman Daily, with your weekly Friday video. If you want to subscribe to the Bauman Letter, which you can do for 1 year risk-free, click on the little icard above my left shoulder. It would be great to have you on our team. Today I want to talk about inflation, especially why inflation is something that should worry us as stockholders, but should also encourage us and cheer us as stockholders. It's a paradoxical thing. First point I want to make about inflation, it's been in the news a lot. Everybody keeps talking about it. There's always concern about inflation. Whenever there's a monthly report, everybody freaks out. Now, the reality is that the debate about inflation is political. The economics can tell us, it can measure inflation, but it can't tell you what to do about it. Fundamentally, your attitude towards inflation depends on your values. And it really also depends on your position in the economy. Are you an owner of financial assets and capital, or are you a wage earner? Those two groups of people have very different attitudes towards inflation, though the narrative tends to try to push us in one direction, and I'm going to tell you which direction that is. Going back to the decade before the great financial crisis, the interests of the financial sector and really holders of financial assets like stocks have dominated the narrative about inflation. They've set the terms of the debate. And the terms of the debate are that inflation is bad for three reasons. Number one, it could lead to higher interest rates, which could choke off growth. Number two, it could erode the value of fixed savings, retirement savings, people who keep cash in the bank. And number three, it increases the cost of living for wage earners, which is one time when wage earners seem to be the primary concern of that particular group. But inflation and interest rates are themselves a reflection of a strengthening economy. In a sense, they're a price signal that tells us that things are getting better. So why wouldn't you want that to happen? More people will get jobs, their wages will rise, they'll be able to buy more goods and services, profits will rise in a sustainable fashion. So why are you worried about inflation? Well, the dominant narrative says we should really oppose it, or rather, this is the subtext of the dominant narrative. What they don't really say is that it's bad because it erodes the value of debt, which is a critical part of the balance sheets of all banks. So if you lend people money in year one and the inflation rate goes up and it's a fixed term loan like a mortgage, then the money you're getting repaid won't buy as much stuff as it would in the year you made the loan. Therefore, you're losing as the lender. So people who lend money are really against inflation because it hurts their interests. And of course, we're an economy that really runs on debt. I've showed in other videos how debt has really become one of the primary drivers of all economic activity in the United States and of course in the world, which therefore means that the holders of debt are becoming much more powerful in terms of narrative, who gets listened to. Second issue why these guys worry about inflation is that it leads to higher interest rates, which increases the discount rate applied to risk assets like growth stocks. We all saw last year how stocks in small technology companies or companies that had not yet made a profit but were expected to grow rapidly skyrocketed, right? Their PE ratios went up into the hundreds in some cases. At one point, the price to earnings ratio for Tesla was over 1,000. You'd have to wait 1,000 years for Tesla to catch up to its share price at its current earnings level. Now, of course, the idea is that earnings will eventually catch up, and that's why people bid these things up. But if earnings are discounted against a certain interest rate, if inflation rises and that interest rate rises, then the discount rate changes, and therefore those future earnings won't be worth as much. That means that people who hold these growth stocks get hammered. Now, if the average person in America doesn't care about that, because only 54% of people own stocks, and about 90% of stocks are owned by the top 10% of wealth holders in the United States. So they don't care about PE ratios, they care about jobs and wages. And yet, because people like us who own stocks are the ones who basically write the headlines at places like the Wall Street Journal and CNN and CNBC, we're worried about inflation because it could hurt the value of companies that we're invested in. So that's the second reason. The third thing, of course, is that it empowers wage earners to capture more of the output of business. Any business basically produces stuff, hopefully for a profit. Part of the income from the business goes to workers, part of it goes to the owners of capital. Now, when wage earners are in a position to ask for more money, and when capital, owners of capital have to pay it, the rate of profit goes down, and that's bad for owners of capital. And that tends to happen in inflationary environments, as I'll talk about in the moment. Now, the reason why we have had low interest rate regimes over the last decade or so, I would argue, is because the people who have argued these three things, the erosion of the value of debt, the changing of the discount rate at which we value assets, and the worries about wage inflation. Those are the people who dominate the narrative. So what's happened is that they've actually sustained a narrative that says we have to keep interest rates low, because eventually that'll make the economy grow. Well, what happens if it's the opposite? What happens if low interest rates actually hinder economic growth because it prompts people to invest in the stock market rather than in economic production? It prompts them to invest in land and houses rather than in a job-creating enterprise. What if it's the opposite? What if inflation and higher interest rates actually are a sign that people need to get out and produce more and increase the supply of goods to meet increasing prices, because prices are a signal? What if we're about to make the same mistake that we made after the 2008 crisis? Let's see. Well, the theoretical basis for trying to fight against inflation goes back to something called the Phillips curve. It says there's a trade-off between unemployment and inflation. Here's the Phillips curve here. You can see that if you want inflation to drop, you need to raise the unemployment rate. Now, that's a pretty blunt instrument, and not a lot of people still believe in it. But basically, the fundamental argument is that one of the key drivers of inflation is everywhere and always wages. In other words, that the problem is that ordinary wage earning people are making more money than they should, I guess, is the argument. But that value judgment is really based on what I've been talking about, the fact that certain people have an interest in seeing inflation stay low because it's good for their bottom lines, even if it comes at the cost of higher unemployment. Now let's look at the current unemployment scenario in the United States. This is the context in which we are worrying about inflation. During the run-up to the 2020 coronavirus crash, about 20.5 million jobs were created. That's a good thing. We still didn't see any inflation at all, though, and I think that's worth noting. Then we saw a loss of 22.36 million jobs in short order. Then we saw payrolls change, but we are still essentially below. We're still below 6.7 million jobs less than we had before the corona crisis. We've added 3.26 million jobs this year during 2021, which is a good thing, but we still have a ways to go. So I alluded to just a moment ago the fact that we didn't see price inflation during the period when wages were rising right towards the coronavirus crash. Well, that's not a new phenomenon. Here's a chart that shows the overall trend in inflation going back to the 1960s. We did have a big burst of inflation back in the 70s, which everybody talks about. They were very closely related to energy prices, the Arab oil embargoes, which led to energy price increases. And of course, workers back then were unionized and able to demand that their pay packets increase along with inflation, which tended to make it rise in a cycle. It was a vicious upward cycle. Then along came Paul Volcker, raised interest rates at the Fed, and inflation crashed. Ever since then, it's been on a downward trend. You can see the trend line very clearly. And where we are right now, the far right-hand bottom corner, inflation is really not all that different from what it has been for most of the last decade. In fact, it is about where it was in 2018, 2015. It's below where it was in 2008, 2006, 2001, and so on. So right now, although people are freaking out about inflation, the overall rate of increased inflation is still declining over time. And what we're seeing is a blip that isn't all that different. Now, this has a lot to do with the Phillips curve, I believe, and let's have a look at the Phillips curve from a historical perspective. Remember, the Phillips curve says that when you have too little unemployment, too much employment, inflation goes up, and therefore you have to raise interest rates to reduce inflation. Now, here's a chart that shows the Phillips curve over 3 periods. The black dots, the dark blue dots at the top show 1975 to 84. And yes, there was a definite relationship between unemployment and inflation. When unemployment was very low, inflation tended to be higher. Between 1985 and 1994, however, that relationship became much weaker. There still was a slope, but it was very, very slight. Now, during the period 1995 to 2013, which I know is missing the last decade, there was really no relationship. Basically, you could have any level of unemployment you wanted, and inflation didn't rise. Now, what's the reason for that? Well, bottom line is China. China came in to the WTO in 2001 and essentially became the workshop of the world. And what that meant was that the the productive capacity restraints that we had before China really opened up business as the world's manufacturer no longer apply. In the 1970s, most of the stuff that people consumed was made in American factories. And therefore, if you ran out of production capacity, but there was still money being pumped into the economy, then prices would go up because you couldn't keep up with prices. You basically couldn't produce enough stuff. Now, with China as a manufacturer, and increasingly Vietnam, Malaysia, other parts of the world, that resource constraint has been removed, at least for the time being, which means that there tends to be less pressure, at least in a globalized economy, on inflation. We don't run out of resources to produce goods because we're tapping into the whole world. Now, this goes back to the basic philosophy of inflation. Some people, usually on the banking side of things, the financial assets, the stock market side, say that inflation is always and everywhere about money. That's what Milton Friedman said, that if you increase the amount of money relative to the amount of goods in the economy, prices will go up. Well, that's true in a very, very short term, but in the long term, prices only go up if you run out of productive resources and you're still adding money to the economy. As long as there are people unemployed, as long as there are investments that could be made, as long as there are things that people can make that other people will buy, then as long as the price signals are there telling people to invest in doing those things, then things will go well and you won't have long-term inflation because production will rise to meet increased demand. Now, what happens when you keep interest rates artificially low is you reduce those price signals. You eliminate them. You prevent people from realizing, hey, we need to hire more workers because there's more opportunity to sell our stuff because prices are rising. Hey, we need to invest in our business because we could be selling more things. Look, prices are rising. Instead, the narrative of the financial sector and of owners of shares dominates and says, oh, no, we want interest rates to be low. We want the economy to slow down because that's better for us, which is exactly the opposite of the way the stock market is supposed to work, folks. What we're supposed to do in the stock market is to invest in growing businesses that sell things and make money and then distribute income to us. It's not there to speculate just based on price movements that are driven by artificially manipulating interest rates and keeping inflation down. Because in the long run, that's not good for the economy. And it means that we become more and more dependent on the monetary authorities to keep the ball rolling. Exactly what I spoke about last week, what I spoke about the week before. So my message today is, paradoxically, you might want to see some inflation and higher interest rates if you want to see growth, if you want to see the Fed's dominance recede, and if you want to see a healthy economy. This is Ted Bauman signing off. I'll talk to you next week. Bye-bye.